Here's a scenario I want you to think about. Let's say a couple. We'll call them Dan and Sally. Dan and Sally just retired. Dan is 65. Sally is 63. Together, they have 3 pools of money: a traditional IRA with 1.2 million in it, a Roth IRA with like 300 grand in it, and a taxable brokerage account with about $400,000 in it. Their combined Social Security is $48,000 a year, and they need roughly $10,000 a month or 120 grand a year to cover their lifestyle. That means they're going to need to pull about $72,000 a year from their investment accounts to cover their living in excess of the Social Security income. Here's the question. What we're going to discuss today is which account does that $72,000 come from? Hey everybody, welcome back to your classroom. This is the Functional Retirement Podcast. I'm Thatcher Taylor, certified financial planner, and I'm the owner of ProPath Financial that specializes in retirement planning and specifically income distribution strategies. And in this show, like all the other shows, we're going to talk about what retirement planning actually looks like in practice, the concepts, the trade-offs, and the questions that you really need to be asking. The answer to the intro, and I want to be upfront about this, is it depends. Where $72,000 or where the income that you need to supplement your retirement living, how it comes out of your account is somewhat subjective. Depends on your tax bracket, future required minimum distributions, Medicare, estate planning goals, a dozen other variables that are specific to each client's particular situation. How much in investments you have? Do you have any pensions? There's a variety of stuff. So there's no universal right answer besides doing good planning and making sure you're making a good decision on your behalf, not trying to utilize another friend, family member, or colleague's distribution strategy for your own. Here's what I can tell you. This decision is far from trivial. We got to do it thoughtfully. And withdrawal sequencing, if done thoughtfully, is one of the most powerful levers available for managing a lifetime's tax burden and making sure your money lasts as long as you need it to. If you do it carelessly, like using your neighbor's distribution strategy, or if you try to do it on autopilot, it could literally cost tens of thousands of dollars, either paying too much in taxes, or it could cost you too much up front where you don't have enough income later. So today's episode is an educational deep dive into the major concepts and strategies that financial planners or good financial planners should use when they're thinking about this specific area. We're going to cover how different account types are taxed, the conventional withdrawal approaches, its limitations, bracket filling, tax-efficient retirement income planning, layered withdrawals, proportional withdrawals, Roth conversions, IRMA, which is Medicare surcharges, and everything that goes along with it. The goal of this particular episode is to give you a thorough understanding of these concepts so you can make more informed decisions and have better conversations with hopefully your own financial planner. Nothing in this episode is personalized, but it's pretty generic rules that apply to everyone regardless. So take your unique situation in these decisions, use them to make good decisions on your behalf. All right, let's move into different account types. Oh, and really quickly, I don't have much of a social media presence. So as you're listening to this, please make sure to share it with anyone that you think this information and income distribution strategy information will be valuable for, so we can educate as many people as possible. You can find this on Spotify, Apple Music. You can go to propathfinancial.com and on YouTube, youtube.com/propathfinancial is where you can find it, unless you're watching it that way right now. But please like, subscribe, thumbs up, good reviews, 5 stars. I love them, and share them with anyone you know. Let's continue with the podcast. Okay, before we talk about the withdrawal strategies, we need a clear picture of how these 3 main account types operate and are taxed. because the tax treatment is what makes the sequence of withdrawals matter so much. Let's be clear about that. I know longevity risk and making sure the assets last a long time is important. Passing heirs is important, but with a withdrawal strategy specifically helps take care of unnecessary tax burdens. Okay, so the traditional IRA, the Roth IRA, and the taxable account. Remember, our clients Don and Sally have 1.2 million in a traditional IRA that came from an old 401k. They have the Roth IRA with $300,000 and a taxable account with $400,000. So first, the traditional IRA. When money goes into a traditional IRA or 401k, not Roth versions, the pre-tax versions where you got the tax deduction up front, it typically goes in pre-tax. That's what we're talking about. That means the contributions reduce taxable income in the year that they were made. The money then grows tax deferred. No tax on dividends, interest, capital gains, any appreciation that happens while the money is within that account type. But when the distributions come out, every dollar is taxed as ordinary income in the year that it's withdrawn. To put numbers to it, if someone in the 22% federal tax bracket, marginal tax bracket, withdraws $50,000 from their traditional IRA, and that $50,000 is all in the 22% tax bracket, they owe roughly $11,000 in federal income tax, and not to mention whatever your state taxes are, depending on your state. That $50,000 is stacked on any additional or other income that you have, including Social Security. So the more that's withdrawn, the higher the total taxable income could potentially go. And then with these particular type of accounts, there's also mandatory distributions called required minimum distributions. And depending on your date of birth, they could be at 73 or they could be at 75, where they require you to make distributions out of your tax deferred accounts. Required minimum distributions. The amounts for these are calculated based on the account balance used in the IRS table that applies to your life. Whether you're single, you're married filing jointly, you have a spouse that is a lot younger than you, specifically more than 10 years, they're all different calculations. So whether you try to defer these IRAs or 401ks down the road, there will be a time where you either are going to distribute on your own or the IRS is going to make you distribute that money. So what if you wanted tax-free retirement income? That's where the Roth comes into play. The Roth IRA is the exact flip. Contributions go in after tax, so you don't get a tax deduction. You don't get a reduction in your taxable income in the year that money goes in. The money does still grow completely tax-free. That's similar. There's a little overlap there. Qualified withdrawals in retirement, including growth, dividends, interest, capital gains, as long as you don't break the rules, they come out completely tax-free. There's no federal or state tax ramifications from distributions from Roth, but you don't get the tax deduction up front. So let's say if someone contributed $50,000 to a Roth IRA and it has grown to $200,000, by retirement, they can withdraw the entire $200,000 and owe zero federal income tax. It's $150,000 of growth that's completely tax-free. The longer the money has to grow, the more powerful it becomes because the account's larger and larger and larger. Also, this passes to heirs tax-free, passes to your spouse tax-free, whereas the 401k and the IRA do not. The Roth also has no required minimum distributions during the account owner's lifetime. And I know what you're thinking. You're like, man, that seems like a good deal. But remember, you didn't get the tax deduction up front. A feature that distinguishes the Roth from the traditional IRA or the pre-tax 401k is it can simply continue the compounding growth with the underlying investments if it isn't needed, or it can be utilized strategically in specific years for specific purposes. There we go. We're starting to plant the seeds for our withdrawal strategy. And like we mentioned, it's great for legacy assets. As people inherited Roths, they're tax-free. It's a really, really amazing tool. But this leads us into tool 3 that doesn't really share the same rules as the previous two. It's the taxable brokerage account. But man, this is, in my opinion, the best account to have for retirement. Okay, the taxable brokerage account, not an IRA, not a Roth. This is money that you've already paid tax on and you buy whatever you buy within the account. It doesn't carry the same tax rules as the two accounts that we just mentioned, but they're also not potentially as costly as people assume that they are, particularly for retirees in lower brackets, and sometimes retirees in larger brackets too. So money goes in after tax. Along the way, every year, depending on what you invest in, there could be dividends or interest that are taxed in that given year. The year that they're received, there's going to be taxability with dividends and interest. When investments are sold, only the gain above the original purchase price, which the original purchase price is called your basis, is subject to tax. And the investments, depending on how long they were held, if they're held more than 1 year, they get more qualified tax ramifications of long-term capital gains, which is lower than ordinary income rates in a lot of cases. But if you held on to it for less than a year and you sold and you made money, you're probably going to be taxed very similar to ordinary income brackets. So another example, say you purchased Tesla or Apple or whatever for $30,000 and it's now worth $80,000. The taxable gain is $50,000, not the full 80. So there's a partial taxability. Again, if you held it more than 1 year, the gain, the $50,000 is long-term capital gains. If it's under a year, your ordinary income tax brackets essentially. So you get control and flexibility in this account. You can also tax loss harvest. You can invest in a variety of things, and it creates future flexibility for your retirement planning as you work through retirement with your income distribution strategy. Okay, we got the foundation in place. These are most commonly used account types for people in retirement that you can have houses, but we're very difficult to turn them into income unless you do some sort of reverse mortgage or you have rental properties. But we're not talking about those today because those would be some sort of income that would be stacked on other income sources, where then we would have to find your withdrawal strategy from your other assets. So now we're going to talk about some of the withdrawal sequences that most people talk about. The conventional approach goes like this. You draw from your taxable account first. So Don and Sally are withdrawing from their taxable account first to $400,000. Then the tax deferred accounts like the traditional IRA or your 401k, and then you save the Roth till last. That's very common, and it is an approach that is used for some people, and it works just fine. The rationale is very intuitive. Tax advantage accounts get the longest possible runway to compound. So the Roth can compound the longest and build its future income source for you completely tax-free. The logic is protect the Roth as long as possible. And we do that by utilizing the taxable account. In addition, potentially in these early years, if you're in lower tax brackets, the taxable account helps keep those brackets low. This is just, again, kind of the fastball. It's the most commonly used method. For some retirees, this approach has real merit, can be utilized very successfully, but there are gaps in this. You may be already thinking about some of the gaps. A gap that you may be thinking of was, well, if they're in a low tax bracket early and they're going to have RMDs out of IRAs and 401ks later, why don't we utilize some of that money now in the low tax brackets so we can reduce future RMDs? Oh, okay. Well, that makes sense too. Maybe we'll talk about that. So keep listening. That leads us into the intro of this. Is it possible to be too good at tax deferral? This is the first counterintuitive insight, is that some people can be too good at tax deferral where we keep kicking the can down the road and then your required minimum distributions are so big that you have to distribute them. You're getting big income chunks in your mid 70s and for the rest of your life, and now you're getting big Medicare charges. So if you leave it to compound long enough, it can grow so large that it actually becomes a tax liability rather than an asset. The account that was originally designed to save you from taxes ends up creating a worse tax situation than if it had been managed more actively along the way. So Don and Sally, if they follow the conventional sequence, spending their $400,000 taxable account first over roughly 5 to 6 years. And again, let me just say, these are kind of arbitrary numbers, random years. It's important to take this concept, think your way through it, and then go fine tune it with your own advisor. But say they spend their $400,000 taxable account first over roughly 5 to 6 years. While the IRA grows untouched, that 1.2 million could reach 1.6 million or more, depending on what you're invested in, by age 73 or 75. So add a couple more years, again, depending on the year that you were born, which I think is 1960. If you're born before 1960, RMDs start at 73. If you're born after 1960, they start at 75. Those are new CARES Act and Secure Act 2.0. At that balance, your first year RMD would be approximately $62,000. Now add that $62,000 RMD to $48,000 in Social Security. Their gross income's $110,000. Before they spent $1 on the lifestyle, a larger portion of their Social Security becomes taxable. Up to 85% of your Social Security could become taxable to you depending on what your provisional income is. That puts them in the solid 22% federal tax bracket. And we'll talk about it a little bit later. That's going to increase IRMA and Medicare surcharges all on top of that. So that compounds over time because of inflation. Their spending needs keep rising each year. So again, if you defer the taxes, it's building a bigger pot of money down the line. This is what planners mean by the too much deferral problem. The IRA that you left untouched for years, watch it grow, to maximize early years tax deferral, usually the tax deferral that happened decades prior, eventually becomes so large that withdrawing from it could become a tax problem. So the fundamental insight is this. The goal in retirement income planning is not to defer taxes. The goal is to pay taxes at the lowest rate possible over your lifetime. I can't make that clear enough. Reducing your lifetime tax bill is what is most important. Deferring taxes to a later date is not the same thing because you could get big tax bills on the tail. Okay, so how do we manage this? And I know I'm probably being redundant, but you plan for this, but very specifically with bracket management. The planning aspect helps you to look at your potential brackets over the remainder of your life. We as advisors, good advisors that really work through income distribution strategies, when you're getting to retirement, for my clients, I have a very good handle of what your income is going to be every single solitary year till the day you die. There's some assumptions in there, and it may vary, but brackets can be very wide. So I know how much you're going to spend, and I know how far you are into each bracket throughout retirement. So I know how to utilize income sources from the different account types to utilize the brackets properly. So if you're thinking to yourself, well, how do we do this? Manage the brackets. Say it with me. Manage the brackets. If you're in the car with your wife, turn to them. Manage the brackets. If you're on your couch watching this on YouTube, manage the brackets. So the United States uses a progressive income tax system. That means different portions of income are taxed at different rates. Not all income is taxed at the same rate. It's taxed at the same rate for everybody that's within that bracket. But the 10% bracket covers a certain amount of income. The 12% bracket covers a certain amount of income. The 22% bracket covers a certain set of income. The 24% bracket covers a bigger set of income. And then the 32, the 35, and 37% brackets cover a large swath of income. These brackets inflation adjust every year. The newest tax rebuild, the better tax bill, the Trump tax bill, just came out with larger, wider brackets that everyone's going to be falling into. So here's the critical thing to understand. In retirement, many retirees find themselves in these brackets and maybe inching into other brackets and they don't even realize it. So as they start stacking more income on these distributions, they're getting taxed more and then they're pulling Social Security in, and then they're pulling Medicare surcharges in potentially. And so you're having these big tax bills that you did not expect. You help to navigate this. It's unavoidable, but you navigate this on a year-to-year basis by distributing income from the right sources to control the tax brackets. That's the major opportunity. And you can't just do it by, oh, my IRA is the biggest. I'm going to take the biggest chunk from there. Well, maybe you just threw yourself in another bracket. Now you're getting Medicare surcharges and you pulled in more of your Social Security into it. And you really set yourself behind, and you're coming to your financial advisor, which should have been ahead of this for you, or you're coming to your CPA all upset because you're paying a huge tax bill in retirement, which to pay the bill, you got to distribute more from your assets. And it's just a nasty revolving door of negative taxation. Managing the brackets is the first step to evaluating where you should be distributing income from besides the guaranteed sources you're going to be receiving. Okay, let's talk about a little bit of a hybrid approach. Bracket filling is the most important thing that we can try to do to navigate retirement, as much as is within our control. But now we can maybe fine tune it based on how your living expenses fill into how much your guaranteed income fills that bucket. This is more of a broader withdrawal strategy, and it connects directly how a retiree draws from all three account types in a coordinated way. Kind of a pro rata strategy potentially. Now, pro rata is more of a very specific percentage. Pro rata is kind of based off the percentage of each account type based off your overall asset base. You're just doing the percentage of each, which, to be honest, isn't precise enough for me. Can work, could work just fine for you, but that's not precise enough for me. So there's ways that we can look at this to be a little bit more precise and have it make sense. You can start to utilize your account types against the brackets and filter it down to how you utilize your living expenses. This is more of a sequential approach where you can spend taxable, then IRA, then Roth, but it's more specific. So let's say you need, again, the $100,000 a year for living expenses, and you get $48,000 a year from Social Security. We got to supplement $52,000. What if we did a portion of it to cover any living expenses that Social Security didn't cover from your taxable account? And then your fund money came from other buckets, not in a very specific pro rata base, but just enough to navigate the brackets. Because what if your taxable account, you could withdraw assets in a very, very low tax bracket, or maybe assets that don't have a ton of growth on them? Those aren't going to fill up the bucket yet. So you can utilize them for some other spending. Then you can withdraw some of the IRA to cover the excess and still protect you within each bracket. It's more of a hybrid approach. Another option is this. What if you don't have any additional income yet? What if you're delaying Social Security? The topic of this particular portion would be delaying Social Security. Where do I get my income? Maybe in this segment of retirement, utilizing some IRA assets while you're in these very low tax brackets, you're not getting any additional income while you're delaying Social Security, could be a great method for you to reduce down the future IRA balance. Let the taxable account and the Roth both defer to later dates. This is something that I've seen work for particular clients that have gaps of time in lower tax brackets that don't have massive spending. That's a key feature of this. To be able to utilize tax deferred dollars earlier in retirement until Social Security kicks in and they don't have any pensions. This alters the conventional approaches of withdrawal strategies that we've discussed already, because now we're moving the tax deferred assets up earlier, the tax free and the taxable assets until later dates. Now, when Social Security kicks on, that would most likely adjust. But again, a good planner and a good income distribution strategy will have these literal dates and times, I should say times, dates and periods in time where you know when income is starting. then we know where the income distribution is going to need to come from, and we know what your spending could potentially be. So we can map and track when to utilize these. And that's how we're able to estimate over the life of your retirement how much you're potentially going to be spending in taxation. We're coming down the stretch here. We're going to talk about two more things. We're going to talk about the Roth conversion briefly, and then we're going to talk about IRMA, the Medicare surcharge. So we've talked a lot about filling brackets, going down the filling bracket path. This doesn't specifically relate to utilizing this for income. It's utilized for building the tax-free bucket for future income. You know how I just mentioned before we got to this part, the potential of spending IRA dollars early in retirement while you're in lower tax brackets? That same methodology also applies to utilizing low tax brackets or low income years early in retirement to convert funds from your IRA or your 401k to a Roth IRA. That money, say it's $50,000 that you take from your IRA, goes on your tax return in that year. But the $50,000 goes into your Roth IRA. Now that money's positioned in your Roth IRA, as long as you follow the rules, you can distribute that money in the future completely tax-free. And you just take advantage of the conversion now and just pay the tax bill now, which most likely you should have some taxable dollars, some cash laying around to be able to cover that bill. You don't want to over-distribute, pay some extra taxes just to pay the taxes. That's what we want to avoid. But the Roth conversion could be a phenomenal tool to what I say one of the biggest rules of all this is reduce down your lifetime tax burden. And one way to reduce down your lifetime tax burden is to make Roth conversions earlier in retirement, pay the taxes now to reduce down future RMDs and more compounding in your Roth IRA for tax-free income or passing to heirs at some point in the future. So filling the brackets is really where you need to navigate when you're making a lot of these decisions. Now, think of all the stuff we just talked about: Roth conversions, Roth IRAs, pre-tax accounts, filling up brackets. This all leads us to the last segment that's really important, is the IRMA surcharge, the Medicare surcharges that you make too much income, and so your Medicare premiums go up. And really quickly, we spoke about it before. I touched on it briefly. But Social Security, if your income becomes too high, there are very specific provisional income brackets, which are pretty easy to hit, to be honest with you. They're very low. Up to 85% of your Social Security will become taxable. Now, that's one kind of additional hit by making too much money that is sometimes hard to avoid, especially if you require a very large lifestyle in retirement and you're spending a lot of money from different places and receiving a lot of Social Security. That's sometimes unavoidable. But the reason I'm mentioning Social Security now is because connected to Social Security is Medicare surcharges, specifically a surcharge called IRMA. This also directly interacts with bracket filling in every withdrawal and conversion decision we've discussed. IRMA could be a big bill, increasing your Medicare premiums hundreds of dollars a month. IRMA stands for Income-Related Monthly Adjustment Amount. It's an additional premium charged by Medicare for Part B. Part B, which covers doctor visits and outpatients care, and Part D, which is D for drugs, prescription drug coverage, for beneficiaries whose income exceeds certain thresholds. It's not a penalty for doing anything wrong. It's just income-based pricing. You make too much money, you got to pay more in premiums. For a married couple, both enrolled in Medicare, your premiums are going to be roughly $4,500 a year combined. IRMA uses a 2-year look back. So premiums for the current year are based off modified adjusted gross income from your tax return filed 2 years prior. So 2026 premiums are based off a tax return for 2024. So the brackets and the jumps in this could be pretty substantial. Let me read you some of these brackets. Let's just do joint returns, joint tax returns. Less than or equal to $218,000. No IRMA surcharge. You just pay the normal premium. If you're between $218,000 and $274,000 of Magi, you increase your premium $81. Between $274,000 and $342,000, it's $202 additional dollars per month. If you're over $342,000 to $410,000, that's $324 a month. If you're greater than $400,000 but less than $750,000, that's $446,000. And then for the very few people who are listening, but that might be some of you, more than $750,000 in Magi increases your IRMA premium $487 per month. Crazy, crazy amounts of numbers, but it kind of is what it is. So going back to those income brackets that we discussed before, the progressive tax system for federal tax brackets, IRMA and Medicare has their own separate segments. So in short, there's two brackets that you need to navigate in retirement. There's the federal income tax bracket, and then there's the Medicare IRMA surcharge tax brackets that you need to precisely look at when you're distributing income and where it's coming from. Sometimes it's unavoidable. But in those years, maybe every fifth year, or every fourth year, or every third year, we could take advantage of these brackets where spending wasn't as high, is a win in the overall strategy of reducing down your lifetime taxation. All right, let's close this up. Let's take a step back, take stock of everything we've covered. I think it's worth naming clearly that even though this topic is as complex as it is, coordination is so important. Bracket filling is a central concept, navigating these brackets. As much as you can, that's what you want to focus on. Filling brackets optimally requires knowing the income that you have, understanding your account types, how distributions are going to change. And the only way to do that is to plan and prepare utilizing very specific tools. Either your advisor can use them, you can create them, or I have them where we can start to project future years, taxation, and where income is going to come from. Nothing operates in isolation. A Roth conversion adds taxable income, which affects Social Security, which affects bracket position, which affects IRMA, large capital gain, ripples through the same system. An RMD that's larger than projected because markets did really well. And a lot of my clients have more equities than you would think. We just weather the volatility and plan around it. Could push you to a higher tax bracket, which could affect IRMA all in the same year. Don and Sally got big bills. They're mad at their other advisor. It's all because each decision has a ripple effect. That we need to stop those ripples. We can do that by planning and preparing properly with a truly comprehensive withdrawal strategy that navigates how to pull money from different account types to meet the income needs by navigating tax brackets the best that we can. So here's what I hope you took away from today's episode. Retirement income is a math problem, but it's not only a math problem, it's a tax problem. The tax dimension of retirement income is one of the most underplanned areas in personal finance because it takes a lot of work, it takes a lot of time. Many retirees, think about your parents, spend decades carefully accumulating all of the wealth that they have. And then they kind of just distribute it in whatever the way they have it. That leaves significant opportunities on the table. The concepts we covered today, understanding how each account is taxed, recognize the danger of too much tax, bracket filling, understanding the hybrid approach, taxable assets, Roth conversions, IRMA limits. These are all building blocks of a thoughtful distribution strategy. None of what we discuss tells any of you exactly what to do. And that's on purpose. I know you probably came to this, tell me what to do, tell me what to do. I can't. Every situation is different, and the right approach is the one that's built around your specific numbers, your specific goals, and your specific circumstances. But understanding these concepts gives you the vocabulary and the framework to have more informed conversations with your planner. I would love for you to be smarter than your financial planner and ask better questions. you got to continue to do the research and make sure everything is working the way it's supposed to. That's all we got for today. Thank you so much for listening. As always, I don't have a huge social media presence. Please share this with anybody that you think will be valuable. Make sure to follow, like, subscribe, comment, thumbs up, leave a good review. Anything that continues to promote the channel, the more high quality promotion. If you have honest feedback for me, go to Thatcher, THATCHER at propathfinancial.com and give me some honest feedback. You'll see the link to that information in the show notes as well. If you want to chat more about your particular situation, I specialize in high net worth income distribution strategies for clients. Go to propathfinancial.com, link in the show notes. I'll be happy to chat with you more. Thank you so much for listening. We'll see you next time.